Bloomberg Audio Studios.
Podcasts, radio, news.
I'm Stephen Carroll, and this is Here's Why, where we take one news story and explain it in just a few minutes with our experts here at Bloomberg. The European Central Bank is set to cut interest rates for the first time since 2016. ECB President Christine Lagarde says she's confident price rises are under control. Here's what she told Irish broadcaster RTE.
No predicament, no prescription, no commitment. But it is a case that if the data that we receive reinforce the confidence level that we have that we will deliver 2% inflation in the medium term, which is our objective, our mission, our duty, then there is a strong likelihood.
But in the United States, Federal Reserve Chair Jerome Powell is seeing different signals in the inflation data there.
The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work.
The result, one central bank is cutting and one isn't, at least for now. In the past, that's led to volatility on markets. So here's why growing central bank divergence might not be a problem. Joining us now is Bloomberg Opinion columnist Daniel Moss. Now, we often hear where the Fed leads, the world follows, but not this time. Why could that be a problem?
By the end of this interview, you're going to wish you were Harry Truman asking for a one-armed economist. I'm not an economist, but I have covered and written about and been responsible for coverage for central banks for a long time at Bloomberg. And I'm not sure the divergence is great. I'm not sure it's growing, and I'm less convinced that it's a problem. So, despite what a lot of central banks say, they say they're independent from the Fed and they don't do things just because the Fed does things. Well, that's true. However, there does tend to be a broad historical correlation. So many times over the years, I've heard central bank governors from, say, Indonesia or South Africa or somewhere in Central America say, oh, we're independent of the Fed. Fine, but broadly the patterns follow. Now, with regards to the ECB, my impression is they've talked themselves into a June cut, and they more or less have to go ahead with it because they've talked themselves into it. I've not heard any convincing strategy or any convincing timeline ECB policymakers have coalesced around for what comes after June. It's like, we've got to do it, but what? Maybe we should wait for a while. The other thing I would say is, if the divergence is so great, and if we're not waiting for the Fed, and if we're not hung up from the Fed, then put yourself in the room at Bank Indonesia's last surprise rate hike. The opening statement from the governor was all about what's going on in the US. I may have missed it, but I don't recall Jay Powell beginning a press conference talking about Indonesian domestic conditions.
Well, we'll wait and see if that happens the next Fed meeting. You've been writing, though, about the massive shift that we've seen in recent months about what markets are expecting from central banks in terms of rate cuts. Is this just a question of expectations versus reality for these central banks?
Look, it's part of it. And I would say the US gets the headlines on this, but it's a far broader phenomenon. If you go back 6 months, people were predicting that quite a few central banks in the region where I'm sitting now, Asia Pacific, would be either cutting or well on their way. Now, that hasn't happened. And in one instance, the Reserve Bank of New Zealand said publicly that it considered a hike last week. Definitely not a cut. There's a couple of notes flying around about the Reserve Bank of Australia saying, look, we are only one more mediocre inflation report away from penciling in another hike, right? So the last mile of inflation has a bad reputation, and here's why. It can be very, very tricky. Now, is the global economy slowing down as people had feared this time last year? No. If anything, you could make a case that it's re-accelerating. Now, in the era of inflation targets, it's pretty difficult to begin a cutting cycle when you're significantly above target. That's the nuance.
In this uneven progress that we've seen in bringing down inflation, is that as a result of mistakes made by central banks? Or is it just the unique way that this particular inflationary cycle is playing out?
So there was a fascinating conversation which really sort of dragged across a couple of sessions of a recent economic conference in Singapore. And according to the rules of attendance, I'm not allowed to identify people specifically. But there was one very senior policymaker, not from Asia Pacific, who excoriated his erstwhile colleagues, saying they thought it was the end of history. They thought inflation was dead. That was a problem for the 70s and 80s, and let's move on now to the commanding heights of generating employment growth. Well, post-pandemic, that's come back to bite us. And I've got some sympathy for the central banks. They did make mistakes. Ben Bernanke talked in testimony to the UK House of Commons about collective mistakes. There wasn't necessarily groupthink, but, I've got some sympathy because between, say, 2008 and early 2022, late 2021 and 2022, inflation was broadly below target and consistently below target. You go back to the early eras of QE. Now, 20 conservative pundits placed an open letter to Ben Bernanke in the Wall Street Journal back when the print edition meant something, saying all this QE is going to lead to dollar debasement, didn't happen, runaway inflation, didn't happen. Now, inflation did pick up 10 years later, but that was as a result of supply chain issues related to the pandemic. Janet Yellen, in a previous incarnation, called it a mystery why inflation isn't firing. So I've got some sympathy. They heard a lot of people cry wolf. Okay, well, this time it happened. And there was a recent commentary published by Brookings featuring Hassan Afrouzi, Marina Halak, Ken Rogoff, and Pierre Yared that basically questioned this whole it's the end of history mentality. Yared subsequently went on a Brookings podcast and said this: we actually think the future will be more similar to the distant past, in a sense that the more recent past may in fact be more of an aberration. The more recent past was special. There were a lot of pressures that made the job of central banking easier. The more distant past involves central banks feeling a lot of headwinds, as they are now. So it's all still to play for. And by the way, these authors are not predicting higher forever. They think it will get back to target this time. But in coming years, you're going to see more spikes above 2% that need to be addressed.
Making times interesting for you and for us. Bloomberg Opinion columnist Daniel Moss, thank you. And I would recommend checking out Daniel's latest writing on central banking at bloomberg.com/opinion. And for more explanations like this from our team of 2,700 journalists and analysts around the world, search for Quick Take on the Bloomberg website or the Bloomberg Business app. I'm Stephen Carroll and this is Here's Why. I'll be back next week with more. Thanks for listening.